Hi, I'm Isaac Cardoza. I'm a wealth advisor here at Pacific Wealth Management. I wanted to talk about my white paper, what most people get wrong when discussing taxes. I think a lot of times people will hear someone say, I paid 37% or 24% last year in taxes, when that's not necessarily always the case. There's a difference between your marginal tax bracket, which is what they're referring to, and your effective tax rate. So let's discuss it. Under what authority does Congress levy taxes? So that's under the Constitution, and it's under the specifically taxing and spending clause of the U.S. Constitution. The authority was further solidified by the 16th Amendment, which allowed Congress to tax citizens on their income. So Congress passes the tax law, and the IRS, everybody's favorite agency, enforces it. To enforce it, they look at their rule book, which is called the Internal Revenue Code. It's a giant book or digital copy, PDF online, spanning over 2,000 pages, and they update every year, every month with bulletins on specific tax topics, maybe something that's popular, and they provide guidance on that issue. But you don't have to read all 2,000 pages plus the bulletins to understand one of the most basic concepts of the income tax law here in the United States. First, I want to note that this is not legal or tax advice, and this covers only ordinary income, not capital gains. The second thing I want to mention is the idea or the concept of the progressive tax system here in the United States. As you earn more, you'll jump into different brackets and your tax rate increases, right? The more you earn, the more you pay. So let's dive into it. As we start to talk about your marginal tax rate, let's look at the filing statuses that impact your tax rates. As you can see here, your federal income tax bracket is determined by two factors, your total income and your tax filing status. In 2024, there are 4 different tax filing statuses, and there are 7 different tax brackets for each filing status. This chart shows the marginal tax brackets for couples filing as married filing jointly. As you can see, the tax rate on 0 to 23,200 is 10%, and at the very bottom, anything over $731,201 is taxed at 37%. So, what is the marginal rate? Now that we know this, we can look at what this actually is. The marginal rate is the tax applied to the last dollar of your taxable income. Each bracket has a tax rate or a percentage that is applied to those dollars that fall within this bracket. When your income increases and you enter a new range or bracket, you don't pay higher taxes on all of your income earned before you hit this bracket. You only pay taxes at that rate on the income that falls into your new bracket. Here's another way of looking at it. Let's say they make $250,000, married filing joint. Look at this bracket. You're going to see that they're going to fall in the 24% bracket, and the bottom bar of the 24% bracket is, or range, is $201,051. So they make $250. So if you subtract $250 from $201,051, you're going to get $48,949. Call it $950. So of their total income of $250,000, only $48,949 will be taxed at their marginal tax rate of 24%. So that's your marginal tax rate. It's the rate applied to your last dollar earned. It's not 24% over all of your income of $250,000 here. Some of it's getting taxed at 10, some of it's getting taxed at 12, some of it's getting taxed at 22, and eventually you hit the 24% tax bracket. So now that you've seen what the marginal tax rate looks like and what people are referring to when they most of the time misspeak and say they were taxed at, let's say, 24 or 37% on all their income, let's look at what they actually mean and what they should actually refer to, which some CPAs print out and have like on a cover sheet. They're talking about their effective tax rate. So let's take a look at the formula. Effective tax rate equals income tax paid divided by total taxable income. So for a definition, the effective tax rate represents the percentage of a person's taxable income that he or she pays in taxes, actually pays. When you want to think about how much you pay in taxes, this is the number you want to refer to. Is it as large? Does it sound as bad? No. But is it the truth? Yes. And I think it's a good way to measure how much you actually pay in taxes. It's actually the only way to measure, in my opinion. So let's look at another example here on the screen of what the effective tax rate calculation is, the formula, and what this couple in the previous example paid as their effective tax rate. They filed married filing joint, $250,000 in income. As you can see on the right, the amount of tax they're paying at each bracket. Eventually, they hit the 24% bracket. They're not going to be at the top of that range. They're just 250,000, so it's just 49 and change over. And you can see on the bottom, the amount of taxes paid, $46,084.54. So we put that into the calculation, $46,084 divided by 250,000 to get the effective tax rate for this couple at 18.4%. Another chart kind of shows all of it together here and how you can compare the difference. The effective tax rate, 18.43%. Their marginal tax rate, what they were taxed on the last dollar they earned, was 24%. This is important because you can, complain about your taxes in style. Or on a more serious note, you can make the most of your Roth conversions and maximize your tax bracket before you do get bumped up on those conversions. Or in retirement, you can use the tax bracket information to minimize your tax liability and source from different types of accounts and keep this whole big picture in mind of your tax consequences for each decision that you make. That's something that we help our clients with here at Pacific Wealth Management. Thank you for watching this video. If you have any questions, please don't hesitate to reach out. Appreciate it.